Welcome back. I have been speaking to the brains trust of JPMorgan India, Sanjay, Mookim, Sajjid, Chinoy and Madhav, Kalyan. Gentlemen, thank you very much for your patience. Well, I was going to ask about the Capex boom, and all of you have a rule there. First to you, Sanjay, are you seeing even some straws in the wind in terms of companies doing Capex?
Well, the answer is both yes and no, Lata. There is improvement.
On the sector you look at.
There is improvement. You have genuinely seen positive intent from steel companies, from cement companies, etc., which is better than zero, of course. But the one point which I keep making to all my clients as well, you need to scale all these announcements to the size of the economy, to the size of the corporate sector again. I mean, the Indian economy is up 3 times, right? So one power plant in 2004 is equivalent to 3 power plants now, or 3 cement companies now. And therefore, you can't just get excited by a bottom-up counting of announcements. You need to scale it to where the economy is going. And frankly, that number hasn't really moved too much yet. Now, if you look at the total Capex in India, the corporate sector is about half of total capital formation. Households are 30%, and the government's anywhere between 15 to 20% of capital formation. And our hope is that the current conditions catalyze a housing construction cycle, because affordability is up. Hopefully, rates will remain contained, and that's a separate debate, by the way. And that creates demand, which then starts to fill in the conditions for a corporate Capex cycle eventually. But at the moment, there are some green shoots, but not enough to get excited about.
Okay. What's your sense, Sajjid?
Again, the glass half full, Lata, is that the twin balance sheet problem that plagued us for a decade is now gone, has been ameliorated, right? Yes. Bank NPAs are lower. Corporate debt to GDP is the lowest since 2005.
15.5 credit offtake can become 16%, highest in 9 years.
Yes, but we need to be careful because the GDP deflator is running at 11%. So you have to judge this in real terms, which is 5%. Not to say that there isn't encouraging news. My point is the supply side constraint is not binding, but manufacturing utilization, even in March, when you seasonally adjust it, is still at about 72%.
The governor said 75.3.
So I think that's the non-seasonal adjusted, once you do the seasonal adjustment. And I'll just say, in a world where you worry about global slowdowns and recessions, rates are rising, monetary conditions are tightening, let's be realistic that a broad-based private Capex cycle will take time. The implication is the government has to move on with public Capex. And there are 2 challenges. One is, how do you bring your fiscal deficit down and yet continue the Capex momentum, which is very encouraging? And how do you incentivize and enable states? Because they've traditionally been the movers on Capex. So I still feel we need to do more Capex by the center and states to crowd in private investment a year or 2 from now.
Okay. Well, Madhav, on that point, you know, somebody did a chapter and verse analysis of CMIE Provis data. And as of FY22, March 31st, there is supernormal profits of corporates. You know, we all know the earnings growth of last year and the year before. But an outsized amount of money has gone to stock markets, and actual increase in plant and machinery and gross fixed assets is actually down last 2 years running. But this is March 31st. Have things changed in the last 6 months? Are you seeing penchant for at least even inorganic growth?
I think what we are seeing on the ground is Capex, private Capex, linked to what the government has done. Okay. And coming out of the crisis, I think the government, with limited fiscal room, has done a commendable job. And I would say in 3 buckets. One is creating digital infrastructure. This doesn't require a lot of gross capital formation, but the digital infrastructure building blocks that have been put in place, ONDC, account aggregator, digitizing healthcare records, they all are wonderful initiatives. Yes. Then there's services infrastructure. Data centers to support the digital economy, the digital growth that's coming. The banking system is as clean as it can get. In the last decade, we haven't seen the banking system as ready as it is.
Are companies talking to you all for
companies are talking
expansion
to us linked to government hard infrastructure, which is roads, which is the Jal Jeevan mission. So we are talking to people who are all the schemes that the government, cement companies, steel companies, non-ferrous metals, and some PLI-related linkages are where we are seeing Capex at this point. Capex will really become broad-based, to the point that Sajjid said, when consumption-led Capex cycles start kicking in. Right now, it is driven off government spending, which is being done really well, and we are seeing linked to that, we are seeing Capex.
Okay. Well, I have to end with what the stock market wants to hear. What should people buy? I mean, is there still room for banks to run? After all, it looks like the bond index inclusion may come. If that, even the expectation is there, people will be willing to buy banks because there'll be mark-to-market gains. So do banks have more legs to run? Does the market in general have legs to run if you compare previous episodes of valuations?
Well, we are very toppish as a market, right? And while it is impossible to predict when the momentum peaks out, because currently the momentum is very strong, as you get richer and as you extend the market, the theme has to be to reduce the risk in equity portfolios. Like if you ask me when is the market going to correct, I have no idea. Nobody can model that. But I cannot keep adding mid caps, high growth, highly expensive stocks as the market gets more expensive. And what is, like I said, particularly unnerving is India's exceptionalism on a market side, ignoring the equity correction that we've seen everywhere in the world. This appears very difficult to extend.
Justify.
So on a relative basis, banks still look okay. Because when I talked about earlier earnings surprises being principal driver of stocks, there is unlikely to be any negative earnings surprise in banks, at least. Yes, we can talk of growth coming back, etc., which is potentially positive, but no disappointments are likely. So we still continue to focus on banks, which are also fairly priced, especially relative to their own history, right? So there is no extended valuation in financials. And so we still continue to focus our India allocations on large cap financials. Staples on the theme again, Lata, that we are unlikely to see too many earnings cuts. Plus, it's a defensive sector. Numbers are not very volatile to begin with. And these are the two core sectors we like. As a house, we are very underweight the IT space. Yeah, because we still think valuations are very high, and the recession or the fears of recession in the US, or slowdown at least, could drive top lines weaker than people forecast.
Okay. Well, let me see if I can squeeze a 30-seconder to you. Is there any larger medium-term story? You spoke about ONDC. If you look at ONDC, account aggregators, the digital footprint, perhaps more people can be given loans by the banks than they ever could because we have data on them. As well, fertility rate is now in our favor. So is there a better medium-term story for us?
There absolutely is. And for me, it comes down to providing employment to the blue-collar workforce. And I think this is India's moment. If you look at all the global stars, this is very rare. Chinese wages have gone up. China's vacating massive amounts of space. People want China +1. There is all this friendshoring stuff. I think the next 10 years is where India has to increase its export share in manufacturing. That creates the blue-collar jobs, not the white-collar jobs. And I think rarely has there been the confluence of so many favorable stars. Now, that requires a lot of hard work at home. Infrastructure, regulation, labor laws, firm size, but the opportunity is very much there.
Okay, on that optimistic note, Sajjid, Sanjay and Madhav, thank you very much for joining me. Have a great conference out there.
Thank you for having us.